Welcome to all those that have joined so far. We're just going to give it a minute or so to let others log on. Thank you. We'll just give it another minute or so.
Is there a plan in the future, Jan, to do these live?
Yes. Yes, that is the plan for next year to get back. COVID really changed
Sure.
everything. The positive is it allows us to reach a wider audience
Sure.
at a much reduced cost. However, the lack of networking that happens at these events is sorely missing, right? So it has to be a combination of both. Like I said, this allows us to, at a low cost, reach a wide audience that might not otherwise be able to attend. But again, there isn't this, face-to-face and interacting with others and networking, which is key and critical to business success, right?
Right. Yep.
Okay, I think we should get started. Welcome, everyone. This is the SCORE Staten Island presentation, basic record keeping needed to determine your business's profitability and keep your business running. This is sponsored by Flagstar Bank, and a special thank you to Frank DeCandido, CPA, MBA certified financial planner, who will take you through the importance and the basics of record keeping. We see it as applicable across all businesses, so everyone should really learn something today. A few things about how the webinar will be conducted. Your line will be muted. Please use the Q&A versus the chat. Frank has agreed to take questions throughout to keep it more interactive, so I will be interjecting at times and asking your questions. A copy of these slides, along with the recording, will be sent to all attendees. And at the end, there's a brief survey, and I really encourage you to fill that out. That helps us at SCORE Staten Island continue to bring you content that's relevant to your business needs. And of course, we aim to do that free of charge. So special thanks to Frank, who does this, and his generosity of time and knowledge. So Frank, whenever you're ready.
All right. Thank you, guys. Appreciate it. So record keeping, the only thing I can kind of give you analogy is when we do personal financial planning, the first thing I ask them to do is look at their budget. And they kind of look at me with, like, I have two heads. It's keeping everything that you spend, putting it down on paper, and then at the end of the month, figuring out where you spent your money. And just putting money on, saying credit cards is not good enough. It's detailing where and what would you spend the money on the credit cards. And most of the time, they're kind of amazed about how much they've spent. The same thing is happening with a business. You cannot tell somebody who is interested in the business how you're doing without having somebody sitting there and doing record keeping. It's going to save you money in the far end because if you ever get audited or you put your tax return together and you get a letter, usually a desk letter from the IRS or from New York State, and you don't have the documents to back up a specific line, then you're just going to spend more money having to do it anyway. And if you don't do it, then you're going to get your taxes adjusted and you're going to get fined and penalties. So it's really important to make sure that as a business owner, you are understanding how a business is doing. That is the idea behind financial statements. For us accountants, when we put financial statements together, it's we are speaking to the board of directors, when we are speaking to the owner of the company. And it could be one person, it could be 5 people. So without record keeping, telling these people how you're doing, you're not gonna be able to do it. Suppliers should be asking, to see your financial statements. When you go get a loan through a bank, you're gonna need to give them financial statements. So part of the everyday, part of everyday running a company is going to be making sure that everything is detailed, everything is put into the right bucket on the financial statements, and making sure those financial statements are correct. And I would even throw in one of the most important things is doing bank reconciliations. You should be doing those. If the business is big, you should be doing them every week. If it's a little bit of a smaller business, getting your monthly bank reconciliation done is vitally important. If you're not looking at your credit, same thing with your credit cards, getting your credit card statement, putting your receipts aside, and then making sure that every receipt is on this statement. If there's something there that should not be there or is fraudulent, you only have a certain amount of time on a credit card to bring that up to the bank, and they'll let you go on it. But if not, you're going to be paying for that. And same thing with the bank statement. There may be something in there. Somebody took a check. I have a client that we write checks, and the checks are floating out in space. Somebody took the check, and all of a sudden we started getting Geico charges coming out of our bank account and Con Ed bills. All they needed was the routing and account number, and they can filter your account information to pay those loans. If you're not looking at your bank statement, if somebody's not looking at that bank statement on at least a monthly basis, you're never going to know that that stuff is there, and you could be losing thousands and thousands of dollars. We know that identity theft is one of the biggest problems we have in the country. Every 3 seconds, somebody's a victim of identity theft. So if you're not looking at this, if you're not looking at your financials, making sure that everything is correct, you're doing yourself an injustice. So we're going to talk about that. We're going to talk about digital record keeping against manual, depending on the size of the company. Interpreting the financials. The last time I did this on the survey, it's like, well, you didn't put any, examples of financial statements. So I have those to look at, but every company is different. The ratios, if you're a bigger company, you can start to work with this. When I was at Prudential, we had business intake that we were doing because we were running the e-business development group. So it was kind of new. So we were hiring companies. We wanted to do a business case, and we wanted to look at their financial statement. The financial ratios are key. They give you a quick synopsis of how the company's doing over a 3 to 5 year period. Record retention is very, very important. You have certain standards on what you need for the IRS in New York State. We can go over those. We can go a little bit over tax. We're not going to get too much into taxes, but obviously taxes are the end game once you have your financial statements. And then just Q&A. And like I said, if there's any questions as we go along, Gina and Bart could let me know. All right. And I talked pretty much about, why it's crucial. Communicating to the IRS, communicating to suppliers. If you're hiring somebody, they should be saying, how's the company doing, right? So you don't want to, as an employee, be on getting into a company that's maybe not doing very well. And accountability, financial management, all of these come into play. You may want to, at some point, have the ability to open up a 401k for your employees. There's a college planning deduction that you can take to put money away for college for your employees. You got to be able to know that you can afford to do that, and not just go in and then all of a sudden find out that you can't fund it, which is also against the law. So legal requirements, again, if you ever get into a lawsuit and they ask you for records, you got to be able to give them those records. Manual, digital, I do both. Some small companies I do manual, but a bulk of my record keeping is done on either QuickBooks. At one of the high schools, we use Blackbow, we use their financial system, PowerSoft with the Archdiocese. You want to really get into bookkeeping, and you want to be able to do that on a digital basis, because and QuickBooks obviously is probably the most popular one. You can get into trouble using QuickBooks only because you got to know what you're doing. But once you get it set up, you can do automated invoicing, you can do inventory through QuickBooks. It just is a very, very easy tool to use. And it's not too expensive. You can go on and get a simple version of it. It probably costs around $40-50 a month. But then you can just, at the touch of a button, you can tell it to run your profit and loss, run your balance sheet. It's really the easier way to go. If you have a smaller company, then you can use Excel. There are other, I think I have other ones here that you can look at. I have one client that uses a Dome book. It's a big, thick book, but you take a look at every week and you bring forward your numbers, and it kind of gives you an idea of what your total income is and what your total expenses are. And they do it. They're very good at it. And so I take these, I take the book, I make copies of each week. I run their financials, I run their sales tax. That works if it's a smaller company. But some of these other ones, Quicken is just a general kind of a check register. But QuickBooks is the one thing I would tell you to do. I would also tell you that the online version of QuickBooks is where you want to go. They're really not supporting the desktop version anymore, but the online version will give you and your accountant an opportunity to share the file. So if you ever had a question, you could just get them on the phone, they can log in, and you're looking at the same information at the same time. And it just saves a lot of time. I had a client over on the North Shore, and he was using the desktop version. I would have to go to his office, take a download of the QuickBooks file, bring it back to my office, and then send him any adjustments. And I would tell you 9 times out of 10, they did the adjustments wrong. Now we're on QuickBooks Online. It saves me the time of going all the way to the North Shore and then coming all the way back. It's just really the way to go. And you set your general ledger up. It gives you a couple of prefab general ledgers based upon the type of industry that you're in. And it's really easy to use. And like I said, you can send out through email your invoices and keep track of your inventory, keep track of payroll. I probably wouldn't do payroll through QuickBooks. I would do it through a small company. Even ADP has versions for a small company that I would do, or Paychex. Sure Payroll is another one. I would do it through that, but you can also run your QuickBooks, your payroll through QuickBooks as well.
So Frank, I have a couple of questions about QuickBooks specifically, which is why. So one is, I already use QuickBooks Online and also do an Excel spreadsheet on my own as a backup. Is it better to just focus on QuickBooks Online?
Yeah, you don't need to do an Excel spreadsheet. It's just double work.
You can download from QuickBooks to Excel,
Absolutely.
right? If you're more comfortable with Excel, right? You could
100%. Yeah, you can take it as a little button on the top right, and you hit it, and you can hit Excel. You can print it to a PDF file. Yeah, I would just concentrate on the QuickBooks, the online version, and you can always download it to Excel if you need to. I do that for a couple of companies where I have to put together, monthly financial statements for them. I'll just download it to Excel and then use that and put it into an Excel spreadsheet. But there's no reason to do both. It's really double work.
Mm. And then someone's saying that they don't think the online is as good as the desktop, you know.
It's a different look and feel. The desktop version was a lot quicker. And the other thing about the desktop version was you had a button on the top right that you can view any of the reports. So you can open up the balance sheet, open up the income statement, open up your bank reconciliation, and then just toggle between the three. You can't do that with the online version. The only thing I would let you know is that they're really getting away from supporting the desktop version. It's not a long-term thing. So, and again, if you're anywhere, remember, not just your accountant, but if you're out in the field and you need to invoice, you can just log on from anywhere and get on your QuickBooks file and invoice and look at things if you wanted to. So,
Yeah, I mean, I think most technology is moving that way because otherwise they have to push it out and hope you take it. Now
well,
it's always up to date, you know?
if you got to do an invoice, you got to print the invoice, you got to put it and pay for the postage. Hopefully it gets there. Or for QuickBooks, what I do is on my QuickBooks file is I email everybody's invoice. So it takes me 2 seconds. I'm just pressing a button. I'm sitting there, printing them out, putting them all in an envelope, and then mailing it out. You could email it directly to their email. So that's the way I would go.
Okay, thanks.
And again, it's depending on how involved you are, it could be $40, $50 a month, but it could go up from there if you need inventory, if you need other things. So I'm a QuickBooks Pro advisor. You can always call me up. I can get them on the phone, and we can always get the representative to give you the version that's best for you and best looking, if you're looking at saving a couple of bucks, we can get the best price for you. All right. Okay, so when we talk about financial statements, there's 4 major financial statements. And if you ever go online, sec.gov, and you want to look up Ford or Chrysler or Apple, you can go on and just type the code in, the symbol, and their financial statements will come up. Most companies are not going to be that detailed. Most companies don't need an audit. I do a lot of work in the nonprofit field, and New York State, kind of depending on what your revenue is, you'll need a either review or you need an audit. Most smaller companies will only get involved with that if they're X4 by the bank or somebody else to get a financial statement done up for them. But the owner of the company should be looking at least the first 3, at least on a monthly basis. Whoever's doing your bookkeeping should be producing these financial statements for you. Because again, if something's going wrong, even more important than things going right, things are going wrong, you want to catch that, you want to catch that right now. And for budgeting purposes, you know your business better than anybody. You even know what the forecasting is going to be. You may have to make changes if it means laying off somebody or cutting down on certain expenses. If you have no idea where the income's coming from, the expenses are coming from, it's you just eventually you're gonna run into big trouble. The cash flow statement is important. I do run cash flow for a couple of the bigger companies that I do. Again, it shows where the cash is going. And if you don't know where your cash is going, again, you're going to get yourself in trouble. The notes to the financial statements are written narrative and they support the amounts in the income statement. Most of the time, it's not necessary for a smaller company. But again, if you have a bigger company, and especially if you have something going on with your bank, a line of credit, you may need the financial statement notes to kind of explain things. But I'm going to go over these four financial statements, and if there's any questions, you can let me know. The income statement is your revenue and expense. It gives you your net income or your net loss over a certain period. It kind of gives you just a running total of where your revenue was and how much your expenses are. So you have a service company, you have a merchandiser, a merchandising company like a Best Buy that has inventory sitting on their shelves. It's a slightly different financial statement, whereas a service company, a hotel, or a company that does not use inventory, you're mainly going to have revenue and you're going to have expenses. You get down to net income. With a merchandiser, you have to keep track of your inventory, and that's important as well. If you have, I have a pizzeria that has at the end of the year, they have things that they've bought that have not used yet. So for example, you're running a Best Buy and you buy 5 TVs. Until you sell them, it's sitting on the balance sheet as inventory. And then when you sell it, it becomes a cost of goods sold, it becomes an expense, right? You buy it for $100, you're hopefully going to sell it for $200, right? So on your income statement, it's going to show $200 for the sale, and then you have to keep track of your cost. And that cost comes off the balance sheet, goes on the income statement as an expense. So again, we can track this through QuickBooks as well, and that's why it's really important. It's very, very difficult to do it on a manual basis. I worked for Caldor. I'm not sure if anybody ever remembers Caldor. This was in the early 80s. And there was no technology to take care of inventory. We had to shut the store down twice a year, and every department had to come in and they had to count everything that they had. Now with the barcodes and everything else that they have, they know their inventory right off the bat. And if you have a good computer system, it's also telling you when things are getting low. Like if you have something especially at Caldor, we had to know when things were coming up in sales over the next couple of weeks, because we had to know we had the inventory to actually sell this merchandise. So that's where you get, when you have inventory, that's a whole different ball game, and you really need to keep track of the inventory that you have. And inventory is important because if things are not turning over, that means that you're not selling them. That means that you have an inventory just sitting there. You need to know that, because you can't overbuy on an item that's not selling. And that kind of paperwork and kind of detail reports that you need to get per product is really important. If something's not selling, hey, then maybe you put it on sale. Maybe you do a 2-for-1 sale. You wouldn't know that unless you had a report that tells you what the inventory is. And the other important thing about inventory is how long you've had it, right? So if your inventory, if it goes beyond 30 days, 60 days, then there's an issue. You need to have something that's going to move that product. So it's important on a merchandising company to have the right income statement and the right reporting. And this is an example of an income statement. You have your revenues, you have your subtotal, and the expenses. Again, cost of goods sold, salaries, and rent and utility. All these are generally, items that you're going to have on your income statement. Depreciation we'll get into later. When you buy a fixed asset, there's a timing issue. There's a revenue recognition principle that says you buy a piece of machinery. Now, that machinery is going to churn out 1,000 widgets a week. The machinery, though, is not expensed in one shot. Now, there are things you can do on your tax return that is accelerated depreciation, but you cannot do it on your books. So you're going to have that piece of machinery, and you're going to depreciate that over a 5-year, 7-year, 10-year period. That's what depreciation is. You buy a machinery for 100,000. You say it's going to last 10 years. You're taking 10,000 a year, and you're expensing it until the life of the asset is zero, and then depreciation stops. Bad debt provision deals with if you have somebody who owes you money, and all of a sudden you get to a point where you're 90 days out, 120 days out, they may go into bankruptcy. You're never going to collect that money. You can write it off, and that's what they mean by bad debt. But this, is a furniture store, so it's every company is going to be different. Statement of owner's equity is just really quick. Your ownership in the company. You have an S corporation, and you have retained earnings. That's how much the owner has made in the company overall. Like 10 years later, you look at your statement of owner's equity, and your balance in that is what you have accumulated, not only your beginning equity, which is your contribution into the company, or your net income and losses, or with an S corp or an LLC, you're allowed to make distributions to yourself. So what do you net out after everything? And that is basically your book value of your company. Now, it's not the market value. So that's a whole different conversation. But we're only talking about book value of the company. And these are the items. You got your beginning capital. Any investments by the owner gets added. The net income, plus or minus, if it's income, it gets added. The loss gets deducted. And then any withdrawals. Now, a public company, you're not allowed to make withdrawals. The owners just don't have withdrawals. What you have is you have dividends. And they are deductions to the capital of the equity of the company. And then any additions is not investment by owner, but you have common stock that's issued. We're not going to get too much into public companies, but if you look at a company like Apple and AT&T, and you'll see common stock, dividends, preferred stock. That'll be part of the owner's equity as well. And this is just an example. The owner made a $10,000 contribution. They had $180 of income, and then they withdrew $100. Your owner's equity at the end of the year is $10,000. That $10,000 has to show up on the next report, and that's the balance sheet. So this is where you have all your assets. You're breaking them out between current and long-term. Your liabilities, also breaking it up between current and long-term. And then you have your equity section. The assets in total equal what's in your liabilities in your equity section. And again, it's important to know what type of assets you have. Cash, receivables are another big part of small businesses. Who owes you money? The other thing that has to be run is an aging schedule. And what I mean by that is you look at all your accounts receivable and you break it up. You have all your listing of your clients, and then you break it up between 0 and 30 days, 31 to 60 days, 61 to 90, and over 90. When something starts to get into that 30 to 60 day, that should prompt a phone call or an email or both to tell the customer, hey, look, I'm not sure if this was an oversight, but we need to get this thing resolved. Once it gets into 60 and 90, then you have a situation where either you had a dispute, they don't want to pay you for some reason, or they are not willing, they cannot pay you. And that means they're in trouble themselves. And then 190 to 120 to 150, you start to get into the point where when do you write it off? How much time are you going to spend on this customer? Making a note that you really should not be working with this customer going forward. But the aging schedule is very important to have in front of you, and that's something, again, the bookkeeper should be given to the owner on a monthly basis. And this is a quick example of a balance sheet. You have your assets on the left side, land, building, and equipment. These are all things that are instead of land, building improvements, equipment are depreciated. Land by rule is never depreciated, so you should never have that issue. I apologize. But inventory, prepaid expenses are those that you pay before they've been incurred. Investments, you could have CDs that you work with at the company. As a company, you can own stocks. So you have to keep track of those. That's a whole separate thing, excuse me. But these are the current assets. You want to break it up between current and long term, just to make sure that you have an idea of what you need to concentrate on. Plus, when you look at one of the ratios is the current ratio, your current assets over your current liabilities, that ratio should be at least 1 to 2 to 1. So just in case you ever needed to immediately pay off your liabilities, you have the assets to do it. When it comes to the equity section, as I mentioned before, generally there'll be one number, but in here, they're giving you the common stock, the retained earnings. Treasury stock is when you buy your own stock back. We're not going to get into that too much. But this is an example of a balance sheet. And these are the categories: long-term and current. If there's any questions on any of these, just let me know. But again, balance sheet is going to give you an idea. The only downside about a balance sheet is it's 1 day in time. So you could be looking at something on January 31st, and then on February 2nd, get a lot of cash in, or have a lot of accounts receivable, by issuing bills, and that will up the accounts receivable number. So you got to look at these on a month-to-month basis and get a pattern of what's going on in the company. Liability section, again, it's important to know what's long-term and short-term, only because if something's short-term, again, same thing with accounts payable, you want to know where the aging is. You don't want anything to go beyond, 45 to 60 days. That's going to look bad upon yourself. And then you're the one getting the phone call, or you're the one getting the emails. And then as the word gets out that you're not paying your bills, that could be a problem down the road for any new customers. And then you got your long-term debt. Generally, those are mortgages, other things that are lines of credit that go beyond a year. The equity we talked about already. It's the net worth of the company. I mentioned that before. The statement of cash flow is very simply, where the money is going, what you're spending the money on. And there's 3 categories: operating, investing, and financing. And then this is an example of a cash flow statement. I'm not going to get too much into it, but it is important that cash number, whether it's going up or down, you need to know the reason why, right? You could have 1 month that the cash went down. Well, why did it go down? Well, you may have paid a loan off, or you may have bought a piece of equipment. And that's okay, because you know that equipment is going to let you grow and increase your sales later on. But as long as you have an idea of where your cash is going, very important for the company. And these are the types of inflows and outflows that you would see on a cash flow. And then you got your long-term under the investing section. You have your long-term assets. You're buying plant and equipment, or you're selling items. You could have had a big increase in your cash flow based upon the sale of, say, property, plant, and equipment. The problem with that is that that equipment now is not going to be used in the future. So how are you going to replace it? Is it something that you need to look at going forward? And then on the financing activities, usually dealing with long-term liabilities. Again, issuing stock could be a cash inflow, right? So, or issuing debt is another one of your cash inflows. Dividends, withdrawals to the owners. Again, the problem with having you have to look at this only because your equity, especially on an S corp and an LLC, your equity shouldn't go less than zero. Now it can, right? So you can have a bunch of losses, and then I have one company that has a very large equity that's negative, but they've offset that by borrowing money from the bank. The problem with that is that you cannot withdraw money. You can't do anything that's going to make your equity go negative, because if you do that, then you're picking it up as a capital gain on your tax return. So you got to be very careful about the equity number. If you want to withdraw it, you have to make sure that the money is there. On a company that has stock, you want to issue dividends. You want to make your shareholders happy by issuing dividends. You have to make sure that you have the equity in the account in your company to actually do that. Let's see. The other non-cash items that we can gloss over that. The notes, again, as I mentioned, it's going to be a narrative on your financial statements. If there's something there that you want to explain, then you can do it through the notes. For example, if you have a mortgage, you want to tell the reader of the financial statements how long the mortgage is, what the interest rate is, how much you're paying on a monthly basis. Same thing if you have a HELOC or another type of bank loan. You want to detail that out to the user. The financial statements are there so the user can look at them and say, all right, this company is something I want to invest in. Your suppliers are going to need it. Your bankers are going to need it. Your employees certainly you're going to want to know that the company is doing well. If it's not doing well, they want to know maybe that they don't want to stay there. They want to go somewhere else. But the financial statements are going to be able to tell everyone there how you're doing on a financial basis. Interpreting the financials, again, it's part of the decision-making process. You send the financials to a bank, they're going to make a decision on whether they want to, make a loan to you. Same thing with a supplier. They want to know that they're going to get paid. They want to see the financial statements. We talk about external and internal users of the financials. External users are outside the company. The auditor, the board of directors is also someone, if you have a board of directors, especially with nonprofits. I'm giving out financials on all my nonprofit clients on a monthly basis, and they can come back with any kind of decisions that they want. A board of directors is an important tool for you because it's people that are maybe outside the company, but they're making this, they're financially responsible for the company. So they want to see how things are going. Internally, you have people that are running managers of different departments. When I was at Prudential, we had a department in retail and capital markets and international. Those business owners, those cost center managers wanted to know how their divisions were doing on a daily basis. So I actually had to give them daily financial statements. So there are both internal and external users to the company, and these are the ones we're talking about. Customers are another one that are shareholders outside. They want to see how the company is doing. Regulators, if you're in an industry where you have to deal with the SEC or the NASD or the Department of Labor, they want to see these financial statements as well. And again, internal, as I mentioned, these are all internal managers of the company. They want to know how individually their business unit is doing. Again, you won't be able to give them any answers if you're running, if you're not being able to put these financial statements together. The one thing I would go back to also that I'm thinking about on QuickBooks is if you have different divisions within your company, you can set them up as different classes. For example, I had a nonprofit that was a sports, manager. He ran volleyball teams. He ran softball teams. For a little while, he's running a baseball team. He wanted to know how each of those sports were doing individually. So when you look at, you can set it up where you can have a class. And if you're able, if you want to identify it, but that has to be on every single transaction, income and expense. That's a good way to go if you have multiple business units within your company.
So Frank, there was a question about books that are there POS systems that you recommend that work with QuickBooks? So, point of sale systems that you can upload. I mean, you can upload from Excel, right? A lot of times Excel is the median in between the two, the two applications so you can upload a CVS file, I guess, or an Excel file into QuickBooks, yes?
I have one client that's does balloons. That's what they do. That's all they do is sell helium balloons. And she has started a point of sale system. I'm not overly familiar with it. I can get, if someone wants to email me, I can certainly get them an answer on that. I have another colleague of mine, Anthony Bonelli, that's a QuickBooks certified. I'm a QuickBooks Pro advisor, but he is certified in the usage of QuickBooks. We can get an answer for them, but I don't know offhand if they can be uploaded into QuickBooks. There's certainly POS systems out there, but to have them uploaded to QuickBooks, I'm not 100% sure, but please have the person email me and I will get an answer for them on that. All right. I've taught it, at Wagner College, and we run a World of Accounting event for high school students. Last year, we had about 400 high school students. And we talked to them about the opportunities in accounting, whether you want to do financial, you could be in the tax field, you can be managerial, you can do accounting related, bookkeeping work. There are a lot of opportunities, but when you talk about the users of the financials, all these are gonna need it. You're gonna need to give tax guys the financials. You just worried about when you put something down on paper and you hit that button, you submit it. There's always the opportunity where they can come back and say, all right, what's in this cost of goods sold number? Why is it such a high percentage of the sales? And you got to have something to go back on. So there are a lot of users of financial statements, and these are just a summary of what we talked about.
So Frank, there was a question regarding taxation, and his small LLC started operating August 24th, which is, not just started. When is his first estimated tax 1040 due?
Well, it depends on if it's a single member or a partnership.
A single member. It's a single member.
Okay. So a single member LLC does not file a separate tax return. So what's going to happen is the financial statements for his company is going to be given to his CPA, his accountant, and they're going to fill out a Schedule C on his individual tax return. And that's how he's going to get the LLC into his individual tax return. So the financials have to be given to the accountant, whoever's doing his taxes, his or her taxes. And that's how that's going to work. With a partnership, which is two or more partners, then there's going to be a separate partnership return. That's the partnership returns are due March 15th. You could do an extension, and then they're due September 15th. for the partnership. Now, as for the individual, what I would tell you is that he should be looking at the activity before one of the due dates for the estimated taxes. So if he's got a big, I have one client that does very well in digital art, and he has does very well. And so what we do is before every quarterly payment, which is April 15th, June 15th, September 15th, and then January 15th. We go through his financial statements. I do an estimated tax. I put it into my program. I run the P&L through my program, and then I come up with what I think he'll need to do as estimated taxes. So what I would tell the person with the single member LLC is contact your accountant on a quarterly basis before those dates, the week before. Send him the revised profit and loss statement and let him run that through your personal taxes. And if the person's married, you have to incorporate, the spouse's work, or, estimating what the mortgage interest is going to be. And you have to look at the individual return from the prior year. Get an idea of what those numbers are going to look like. Incorporate the P&L of the LLC into their personal into their personal tax return, run the numbers and see if there's any estimated taxes due. And same thing with even the partnership, the K1s. You're going to get a partnership is going to issue you a K1. And that K1 is going to be added to your personal return. You could do the same thing. Take an estimated K1, give it to your accountant, and let them run it through and see if there's anything based upon your prior estimated payments. Maybe you had a good third quarter, and now instead of paying $2,000 a quarter, now you need to up that to $5,000. Or if you had a bad quarter, maybe you can hold off on the third quarter estimate. Those are decisions you need to make with you and your accountant. That answer the question?
I'm going to say yes.
Okay. These are the ratios. There are mainly 5 types. Again, when you get into a bigger company, you can have somebody do this type of analysis for you. I don't think QuickBooks can do this off the top, but I'd have to find that out. I've never seen that on QuickBooks. This is maybe a manual thing that you'd have to do. But we'll go through those. The liquidity ratios, look at your short-term and long-term obligations. And these generally are the 4 types that they talk about. The current ratio is probably the most popular and most used, where you're taking your current assets divided by your current liabilities. The higher here, the numbers, the better, right? So your assets compared to your liabilities should be at least 1.0. Hopefully it's a little higher than that. But you can certainly use these other ones. If you have inventory, you can certainly use those as a tool to know how you're doing on a liquidity basis. Leverage ratios look at debt. And again, whenever we have something that has a liability as a denominator, right, numerator, you want that to be as low as possible. Your liabilities to your total assets, your liabilities to your stockholder equity are really important to see how leveraged this company is. If that percentage is very high, then you're highly leveraged. The problem with that is that if you have an issue where you need cash, it's tough to unwind that. You have this large amount of debt. You have to then look at your assets and see what you can sell. If you have a lot of, it goes back to the current assets, current liabilities. If you have a lot of long-term liabilities, they tend to be very difficult to sell. So if you need money on a short-term basis, you have to look at that. You have to look at that as well.
So Frank, I just wanted to
Yep.
give you the 10-minute warning here. I mean,
Okay.
we're asking and answering questions along the way. There's maybe a couple left, so I just
Okay.
wanted to let you know the time. Thank you.
Okay. I want to get to a certain couple of slides with the taxes just to touch on it, but again, these other ones, efficiency ratio, are good when you're talking about how you're utilizing your assets. You have your ability to generate income through your financial ratios. Again, here, the higher the number, the better. And so you can use this as a guide year to year to year and see where the trend is going. And that 5 year, I would at least go out maybe 5 years if you have that much activity, sometimes 10, and seeing where you're going. And again, if something's going wrong, then you need to dive in and ferret out what the reason is. And then there's market value ratios. These are only mainly for public companies to evaluate how the stock price of the company is doing. Understanding record retention, again, very, very important to keep records. There are statute of the time frame that you need to have your records kept. Really depends on the organization, depends on who you're dealing with on the outside. Generally, tax records, I can talk about that. It's generally 7 years, even though there's a kind of a 3-year look back. If there's something that they feel that's fraudulent, they can go back as far as they want. So I tend to tell people to keep the tax records at least for at least 7 years. You can inquire with your legal counsel regarding your record retention. The nonprofits that I have all have a record retention policy, and every company should have one of those, of how long you're going to keep these. When it comes to bylaws and board of directors minutes, those I would keep for quite a long time. The incorporation papers, obviously, you need to keep them for the life of the company. All right. Past performance is, as I've mentioned with investments, is not a guarantee of what's going to happen in the future, but it is a track record of how the company is doing. And it's important when you run financial statements to run them. You don't want to run them month by month, but maybe quarter to quarter, and seeing how you're doing, and certainly year to year to year to see where the performance is going, so you can make business decisions on where you want to go. All right, just more stuff on forecasting. Tax purposes, again, you need to have any kind of backup that you have. When you get a letter from the IRS, you get a letter from New York State, you need to go back to the records, keep them in good order, and you should be fine. When you look at financial statements compared to tax returns, there are differences, and the main difference is dealing with depreciation. As I mentioned before, you buy a piece of furniture, it's going to last 7 years. You allocate it over 7 years. You take the cost minus any kind of residual amount that you think you're going to sell it for, and then you take that over divided by 7. Those are your expenses every year. That furniture, the equipment that you buy, you have in certain cases, you can accelerate the depreciation. And I'm giving you the numbers a little later. These are some of the depreciation methods. You can take a look at that. But for example, in 2023, on the tax return, Section 179, you can deduct up to $1.16 million. So, and then you have bonus depreciation, which are not, again, this is not a tax seminar, but there are other things you can do that's up to 80%. You cannot create, the only problem with these losses of Section 179 is that you cannot create a loss when you use 179. In 2024, that jumps to 1.22 million. So I would talk to your tax advisor if you think you need an piece of equipment, if you need a vehicle, if you need things in the company, ask whoever is doing your tax return if you're able to accelerate the depreciation. You can do that on the taxes. You're not allowed to do that on the books. And that's basically, you're talking about, those are temporary differences. There are things that are permanent. Again, I don't want to get too much into the weeds here, but just talk to your accountant about some of the differences. There are things that you can accelerate on the tax return that you cannot on the books. This is a publication that you can use, how to depreciate property. We look at that. There are inventory differences between books and tax that you can also do. If it benefits you on your tax return, just know that some of the depreciation in the early years, you can take the loss, but then in the later years, you don't have that loss anymore. So you got to weigh that against doing, each one of these methods where you're taking first in, first out, or last in, first out. Right. Again, the failure to not do this is, it's fine until something happens. You need an IRS letter, you get a New York State letter. An audit comes up. Some other some of the regulatory organizations, they want, Department of Labor, for example, they want to see things, especially if someone's an employee against a contractor. That's another one that we could spend a little time on, making sure that you have that right. Because I had a company that didn't do it right. They paid somebody as a contractor who was doing regular work for the company. It should have been an employee, and they came back and the Department of Labor hit him up with the payroll taxes for that person. So you gotta have that. Those kind of records are correct. Got to have them correct for the employees as well. 3 minutes to spare.
Okay, so I just have a couple of questions. Is there a way to keep track of employees' payroll, such as clocking in and clocking out?
Yeah. There certainly are. We had it at one of the high schools for the teachers where they had a thumbprint. So I don't remember the company that they used. You can certainly go through your payroll company, an ADP or a Paychex would certainly be able to help you with that. But that's a great way to keep track of, with the teachers, they had to come in at a certain time, they had to leave at a certain time. So we did it there, and but yes, you can talk to your payroll company, and there certainly are tools that you can use that are not just on the phone, that are actually, you want something that's physically at the company, that you either put a code in or you have the thumbprint, which is probably the best way to go. It's a thumbprint and a code, so no one else can sign in and out for the person.
Another question is, with an S Corp that are two partners, should there be one accountant doing the S Corp taxes, or should each partner handle their own via their personal accountant?
Well, you need an accountant for the company, right? So if it doesn't matter if it's 50-50, 20-80, it doesn't really matter. Both of these owners are responsible for the company. So you would have an accountant for the company. That accountant could do one of the person's taxes, if you wanted to do that, but having a separate person for the company, separate accountant for the company is certainly important. Now, again, whether I have myself, I'm charging a certain amount, it's going to be higher than you hiring someone just to do the bookkeeping. But we have colleagues of ours that just do the bookkeeping work. So if they needed somebody to come in and on a monthly basis, just do the bookkeeping, we have the ability to do that, or you can just hire somebody, at a lower rate and just have them be there every day and just have them do the billing and writing in the checks, putting everything into QuickBooks. You can do the checks through QuickBooks. You can do the invoicing through QuickBooks. I would certainly use QuickBooks as a guide, but
I guess they want to know your opinion of using like an H&R Block as a finance, as far as that management part,
Well, an H&R Block, you're not going to get the kind of one-to-one, because it depends on who's working there when you come in. H&R Block is more for, individual taxes. Somebody walks in and does their taxes. You know, again, this cost related H&R Block may not be as financially lower than using an outside accountant. There's a lot of colleagues that I know, part of the Staten Island chapter of New York State Society of CPAs, that do a terrific job. They should be your first choice.
Okay. And as far as someone wanted to know about the POS compatibility with QuickBooks, I did a quick search. I would
Yeah.
check with your whatever POS system you're using,
Yeah.
but that it seems to be readily, like Shopify was you know, advertising that they did. So I
Right.
think you know, that kind of uploading is pretty simple these days. So
Yeah.
I
I
think
have it on my list to get back to you, Gina. Maybe we can, once I get an answer, we can get back to everybody.
so. If you could go to the last slide for me.
Yep, sorry. Is that the last one? Okay.
Yeah, yeah.
Yeah, my
So,
information is here as well. So if you have any questions, you can always email me.
okay, so you'll get this presentation as well as the recording, and you also get a survey. I really encourage you to fill out the survey. It helps us to bring relevant content to all of you. So, and we always strive to have it free of charge. That is our mission, to foster vibrant small businesses within our community. So thanks for attending, and special thanks to Frank. That was very informative. Thank you, and hope to see you all again.
Thank you.